Are the wealth secrets that you may not have thought about when you're managing your portfolio? And specifically, when it comes to managing your wealth, have you thought about leveraging money from a whole life insurance policy? We'll talk about that this week. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. This week, we're joined by Kyle Pierce. He is a personal and corporate wealth management consultant, and he is also the co-host of the Canadian Wealth Secrets podcast. He specializes in assisting incorporated business owners and investors with crafting high early cash value participating whole life insurance policies. It's a mouthful, but there's a lot of really great stuff involved there. So Kyle, welcome.
Hey, John, thanks for having me. It's awesome to be here.
In an earlier episode, I had another insurance specialist and we talked about insurance, but we talked about it in the context of charitable gifting, which is kind of niche. Your work with insurance is a lot more mainstream. And I wanted to talk to you about that because it applies to a lot of people. And I think with you specifically, it's a lot of small business owners and people that have corporations that they might want to use. Maybe you can begin, therefore, just by offering a very quick overview of the sorts of people that might benefit from using a whole life insurance approach to the way they go about their wealth management.
Awesome. Awesome. Once again, appreciate you for having me. One thing I want to clarify is that permanent insurance is not for everyone, or I shouldn't say it's not for everyone. It's not for everyone at every stage of life. Those who are just starting the investment journey, for example, probably not something that they're going to be exploring unless they're a certain type of investor. For example, myself, I got into this world because I was a real estate investor. So I was in a position where would have capital sitting quite a bit in between deals if we refinanced a property. And having a policy as a home base was a really great opportunity. And it also helped to deal with some of the tax consequences that we'll discuss. So first and foremost, one thing that I don't want anyone in the audience to misunderstand is that a permanent life insurance policy is a replacement for, say, their investment portfolio. It really isn't. It's more of a tool. And as you grow that portfolio, we're going to be creating essentially more capital gains and therefore more capital gains taxes down the road. And this is where permanent insurance can be very helpful, but it doesn't necessarily have to be something that only the next generation benefits from. And that's where this early high cash value portion comes from. When we design the policy in such a way where it maintains a high cash value right off the bat, we then can leverage against this policy for future asset accumulation should someone be interested in doing so. In real estate investors, private placements, or private REITs, or any of these other types, maybe even business. That's where incorporated business owners come in. There's usually a lot of cash sitting just in case if I need to scale my business, in case there's an emergency, in case another COVID, dare I say it, were to happen where there's a shortfall. Having a high early cash value policy can be very helpful because it doesn't restrict you from having access to that capital, but it also doesn't allow money to just sit there under the corporate or the personal mattress, as I like to say, just inflating away as an emergency fund.
Good. So I like the way you positioned it as another tool in the toolbox. And maybe I should go a little bit further to clarify. Off the top of the show, I talked about at the very high end of the market, people who are multimillionaires, they buy insurance as a means to facilitate charitable gifting. Meanwhile, for most people, the only insurance they really need is term insurance that they will use to offset the cost associated with their premature passing if they have liabilities like dependent spouses and children or a mortgage that they need to pay off. So what you're talking about is somewhere in between. It's not the ultra wealthy, but it's more than just the plain vanilla insurance as well. There's a little more going on, and you can use it for things that are maybe a little bit above and beyond your typical uses, maybe is the way of saying it. So I know that typically you look at people that are getting started using some of the cash value as for an emergency or for business growth opportunities, and sometimes you can use that for other things as well. Maybe you can go into a little more detail to explain how what they might want to use the money in a permanent insurance policy for and how they might go about doing that.
Yeah, so like you had mentioned there, John, there was two extremes, right? We had the ultra wealthy where they were looking for charitable gifting and so forth. And actually, although I didn't get a chance to check out that episode, my guess would be is the fact that the death benefit is tax-free is probably where that comes in. They start to look at all of the different incentives, right? To take some of this extra capital, put it into a policy which is going to grow tax-free and then it's going to pay out tax-free. It's a great strategy there. If we look at the very other end of the spectrum, you were talking about families who require some term insurance to cover in case one of the spouses were to pass, and likely one of the working spouses were to pass. That's a lot of income to cover, especially if you're early in the journey. So what we're doing is it's somewhere in between where you already have a investment plan going on. Typically, this wouldn't be something I would explore until you've already had a bit of a retirement plan in place where you're actually funding your RRSPs or your tax-free savings, or if you're an incorporated business owner that, you're starting to pile up some capital. And why we typically work with business owners is because oftentimes when you're in a business, you're incorporated, and you also have a lot of money sitting under the corporate mattress. And what we're trying to do is we're trying to give them an opportunity to keep as much capital liquid as possible, allowing it to grow tax free. That's the cash value. That's what it's worth while we're living. And therefore, it's still liquid through leverage in order to access if I do need to scale my business, if there's a great investment opportunity elsewhere, or if we're looking for maybe some later tax efficient income down the road. So ultimately, it's definitely not something for someone who's just starting on their investment journey. It's likely going to be someone who has their investment plan in place. They're starting to look at a base case and going, I think I'm on track to hit certain goals in my retirement. And now they're starting to look for ways that they can optimize from a tax perspective, but also to provide the liquidity that they might need for other opportunities or cash flow needs down the road.
While still providing some risk management as well, if that's what's needed. So all good.
Absolutely.
Lots of multiple objectives there. Sometimes people will use immediate funding arrangements, and sometimes people will put money in by having the money that's grown over time in the corporation, for instance. Could you maybe take a moment to explain those two options and the benefit of doing it either way?
Yeah. And while a permanent insurance policy can be a great move for high income earners at a personal level, what really supercharges it for an incorporated business owner who has an operating company, meaning they've been earning active income. That means they've been paying tax at a very low rate on the first 500,000 here in Canada. What they're able to do is they're able to fund a policy inside the corporation. They call it a corporate owned life insurance policy. They're funding the same policy that you might be able to own at a personal level, but they're doing it with after tax corporate dollars. So you're actually funding it with less of the dollars than you'd need in your personal pocket. Why? I'm keeping about 88 cents of every dollar on those first 500,000 in my business. Whereas at a personal level, I might only be keeping 80, 75 cents. It could be even worse. If I'm in the highest tax bracket, it could be less than 50 cents per dollar that I'm earning, and I'm funding the same size policy. So there's a huge benefit in doing so, but not to mention that all of those retained earnings in the corporation that are quote unquote stuck there until you take it and are taxed at a personal level, you're able to fund this policy to leverage, as you had mentioned, through an immediate financing arrangement for other investments. But then down the road, that death benefit, we call it the net death benefit, will actually pay out tax free through the capital dividend account out to the estate, which is a fantastic opportunity for business owners to hang on to that low tax rate, kick the can as long as possible, and then be able to get much more out of the corporation without taking on a huge personal tax burden.
I'm curious, do you have any clients that are perhaps not business owners, but just want to do it as part of their estate plan? They'll buy a permanent insurance policy in order to optimize what they give to their loved ones. Maybe not necessarily a charity, but it might be to loved ones. And again, these are people who are T4 employees, so these are not business owners. But do you
Yeah.
find people that actually want to use permanent insurance in that way as well?
Well, more and more people are starting to recognize the power of this asset. Now, if you Google permanent insurance or if you Google whole life insurance, for many years, there were lots of bad actors along the way, putting people into policies that really didn't really need a policy, or they weren't a good fit, or they were almost being convinced that the policy itself was the investment instead of, say, typical investments like equities and so forth, or a balanced portfolio. What we tend to do for those who are at a personal level and they're looking at some of this legacy planning, or they might even be just looking for a safe, conservative portion of their portfolio, an easy way that we look to plan as a starting point is we look at what they have going on in their investments. Then we look at what is their asset allocation mix. How much is equities? How much is fixed income? Because what we can say is that a high cash value policy, not every policy is designed equal, but if we design it to have a high early cash value, it's going to perform in a similar fashion to what your fixed income portion of your portfolio would be performing at. So it could make sense where we actually divert some of that fixed income asset allocation, or what you might be funding into that fixed income asset allocation, and we actually start funding a policy. We still maintain the liquidity, and actually, it might even be less volatile, especially in the short term, because your policy will not go down in value. It'll only go up. Whereas bonds sometimes can go up and down depending on market conditions, specifically interest rates. And you're able to then leverage during your lifetime. And if you choose not to, you'll have a large death benefit down the road, which will pay out tax free to the estate. It is the only asset. No, and I always like to say on the known universe, really, I don't know what else is out there, but outside of Earth anyway, where you're actually looking at an asset that's worth a certain thing while you're living. And when you pass on, it's actually worth more because there is no tax implication. We've got our primary residence, which isn't going to cost us anything in terms of capital gains. We've got our tax free savings, which isn't going to cost us anything. But this is the only asset that actually will go up after we pass on instead of every other asset, either maintaining or going down due to capital gains.
I like the way you depicted it as being almost as if it's a different asset class and using it as a replacement for income. Could you maybe take a moment to explain what you mean by leveraging and borrowing against the cash surrender value in a policy? Because that's a concept that I suspect many people might not be familiar with.
100%. And let's keep it really simple as well. And we'll talk at a personal level where, let's say someone had a 70-30 split. They were doing 70% equities, 30% fixed income. And let's say they planned or they started funding the policy with that 30% that they were allocating to fixed income. So they start building this policy. And of course, this is scalable, but let's pretend it was $10,000 a year that they're funding into this policy. That means that they're going to have significantly more going in, more than 20 to 30,000 going into equities at the same time. There will come a time where this policy is going to continue being funded and the cash value is actually going to get to a place, usually around year 5, where every dollar you fund the policy will be more than a dollar that can then be leveraged for cash flow. So I usually like to get people framed around a 10-year runway or longer. You were to fund this for over 10 years, you're going to have over, this person put 10,000 a year in for 10 years, you're going to have over $100,000 of cash value. And you have two options. One option is we go to the insurance company and we say, I would like to leverage against this policy. And they will allow you to take up to 90% of that cash value. You could do it all at once. You could do a little now, a little later. And you essentially are taking a loan, not income, which could be utilized for whatever you choose, whether it's an investment, whether it's for a little bit of a cash flow crunch along the way, or part of your retirement income. The longer we fund this policy, the greater our cash value will be, the more we're able to leverage for investment or cash flow along the way. The beautiful part is this policy has $100,000 of cash value. The death benefit is going to be larger, right? And typically it starts somewhere around 10 to 15 times as large as the premium. But over time, they're going to get closer and closer together. They're both going to rise over time, but the cash value will eventually be equivalent to the death benefit by age 100. That's how we structure these policies. So, all along the way, you will never get to a place where you've leveraged more than the policy's worth while you're living, and especially more than the policy's worth once you pass on. So even if we're at 100% leverage against our cash value, if I pass on any time before age 100, my death benefit will supersede. It will be a greater number than what is owing on the cash value. And there will be that extra difference for the estate, all tax free. So it's a little bit of a designing part of your portfolio, part of your assets where it could be a little bit of a having your cake and eating it too situation where it doesn't have to be an either or. I spend my assets or I gift my assets. If I do decide to gift assets, they're going to lose some value from capital gains. This is one of those assets that will not go down due to capital gains.
Or let's use an example. Let's say that the face value is $500,000 and you choose to borrow $250,000, half the value against it. What's it going to cost in terms of an interest rate to borrow against the cash surrender value in your whole life policy?
Awesome. So every insurance company will have their own set rate. So some companies, one company in particular, I'll use their name. They're a mutual company here in Ontario. Their name is Equitable Life. They try to keep the rate you're borrowing at a similar rate to the dividend scale that they're actually paying out in the policy. So what they're trying to do is they're trying to make that as equivalent as possible. And that's typically the way they set their interest rate. Right now, it's at 6.5%. We have seen rates coming down, so I'm anticipating that rate may come down as well, but they don't have to change it. They can keep it the same. However, if I go to an outside lender, if I go to a big bank, if I go to a private equity firm, whoever wants to lend against this policy, they get to set their own rules. And typically what we're seeing is they'll do 100% of the cash value. So if there was 500,000 of cash value, you could get $500,000 or you could get any value below that number. And they typically would charge around prime, which is a little better than what you're going to see on a home equity line of credit. So if you think of it another way, one thing I could do if I have a primary residence is I could have a home equity line of credit. Many people do. And I could start to pull income by utilizing my home equity line of credit into my retirement. Why don't many people do that? Because you're borrowing against the house you're living in. That's very scary. It can be risky. Here, we're leveraging against a abstract thing known as a life insurance policy. It's a contract, and you put money into this contract to do certain things. One thing is to have cash value access. The other thing is to have this cash or this tax-free death benefit. So leveraging against that asset feels a whole lot safer than leveraging against your primary residence. Something interesting is you can only leverage up to 65% as a home equity line of credit on a primary residence, whereas over here I can leverage 100%. Why is that? If you were to, let's say, cancel your policy, default on the loan, do any of those things, guess what? The lender comes and they take the cash surrender value. They're basically giving you a loan against a bucket of cash that only goes up and is covered by this death benefit down the road. So it's actually a very attractive asset class for lenders to want to lend against because it's fairly easy if something were to quote unquote go wrong and they had to call the actual loan.
Okay, so let's say you want to borrow $100,000 and it's going to cost you 6%. So you'll be paying $6,000 in interest toward the loan. Borrowing to invest is tax deductible. And if you're in the top bracket, that $6,000 of the loan will maybe only cost you about $3,000 in after tax money because you'll be deducting half. Is that the sort of thing that you help people do the cost benefit in terms of what is my expected return? What is my borrowing cost? And what is my after tax borrowing cost? And then let's see where we break even and where we're ahead of the game.
100%. Whether personally or corporate, doesn't matter which side of the quote unquote border we're on. This is a really important strategy. And usually this is what got me into this world was I was using money for real estate and I was creating passive income. And when you create passive income in a corporation, it's taxed very unfavorably. It's taxed in the highest bracket, essentially. And if you're in a high tax bracket at a personal level, you're in the highest tax bracket. If you invest in anything that's going to produce income outside of your registered accounts, you're going to be paying tax on that money, on that dividend, on that interest, on that rental income. And therefore, when we put a policy in place and we use leverage against the policy to purchase these assets, the ability to write off that interest is a massive benefit because we have a tax free asset growing over here. Typically, you're buying assets that are going to have capital gains, which means we're deferring tax on that asset over there. And any cash flow in between, we're minimizing how much it's costing us because the interest is actually offsetting some of that as an expense so that we're not taking on even more taxable income at a personal level.
All right. So there's a lot of really good things that could be done by using whole life insurance if you use it properly. 5 or 10 minutes ago, though, I heard you talk about how there are some horror stories about the way it was perhaps misused in the past. I don't think it's as bad as it once was, but people still hear the stories. So maybe you could offer some context by maybe offering one story of the sorts of things that maybe used to happen in the bad old days that are less likely to happen now.
Yeah. One thing I can tell you is this is the way, and I always say the way mom and pa's old whole life policy was designed is a lot different than the way and the flexibility that we have today to design these policies. So, said another way, my dad, for example, has an old whole life policy. The way they used to design it was to pay as little premium for as much death benefit as you could possibly get. What that really meant was, first off, I'm going to get this death benefit. It is permanent, so it's not going to ever lapse if I keep funding this policy. So that's a great move. The problem is that those dollars, he has never been able to utilize those dollars in his lifetime. And he still hasn't because he's still with us. And thankfully, that's the case. Only when he passes on will that death benefit pay out. So, with old school policies, they were only really helpful for estate planning. Now, with high cash value policies, we actually open the door to being able to utilize it as a tool and to utilize it as potentially a fixed income replacement of our portfolio. But and this isn't happening as much anymore, but there's still those horror stories where sometimes people are convinced that this is like a better move than investing all in any other asset class. And for some people who are we chatted on my podcast about risk tolerance and your actual risk capacity. Thank you very much. I was going to say criteria. I knew it was a C. Risk tolerance and risk capacity. If those levels are very low for someone, then a policy might be a great fit for them for a good chunk of their assets. However, for many people, if we're trying to compare between, say, equities and a permanent life insurance policy, and we're going to make investment decisions based on those two returns, probably not the best move for a lot of people. So, really, what we want to make sure that we're doing is that anytime we work with a client, we're looking at their full financial picture, getting a sense as to what is their risk tolerance, what is their risk capacity, and how much should be going into asset classes such as equities, and how much might make sense for them to be pushing into a policy. And what do they plan to utilize this tool for? So it's really about just making sure that they're not being oversold on policies. They're not putting too much in if it doesn't really make sense for them. And the reality is, you said it on my podcast, every situation is different. One business owner is all real estate. Makes sense to have a lot of these policies in place because you have a lot of capital coming and going. It's a great home base for their capital. Another business owner who has a lot of money in GICs and is losing 50% of the upside to passive income tax, a policy is a great place for them. Very conservative, not looking for any sort of risk, but they do want liquidity. But somebody who's really heavily into equities, let's say they're a 100% equity investor, they understand the risk, they are okay, and they have the risk capacity to take on that risk. It doesn't make sense for them to have a ton of their capital in a policy unless they're planning on utilizing some sort of leverage strategy in the future. So it's all about just making sure that we know our clients, we understand who they are and what their goals are, and we ensure that we put things in place so we can help them get closer to those goals.
Okay, so Kyle, this podcast is called Make Better Wealth Decisions, and I'm going to spend a moment asking you about your podcast in a moment. But before we get there, I want to talk to you about making better wealth decisions. If you could give the people that are listening today one piece of advice to help with their decision making, what would that be?
I would say the biggest and most important decision they can make is taking more money. So, increasing the actual volume of what they are putting into their assets, whether it's in equities, whether it's in a policy, whether it's in other asset classes, volume and doing this routinely, doing it as often as possible is going to be so key in order to helping them reach their goals and to spend less time worrying and analyzing and overanalyzing over trying to get that extra basis point here and there. I think we spend way too much time and effort focusing on returns instead of focusing on what really matters, which is about the volume of how much we're actually saving. And if we do that, and if we do it conservatively, we will get to those goals and there'll be a lot of room to earn what I call the gravy, which is those higher returns without losing any of that sleep at night.
Hey, it's funny because we both have podcasts. I want to see if you could maybe take a moment to tell the people who are listening to this podcast, because this podcast doesn't usually talk about insurance. For those people who want to learn more about how to use insurance as a legitimate tool in your toolbox, how can they tune into what you have to say?
Yeah, thanks so much, there, John. It's called Canadian Wealth Secrets. We're on all platforms. So, whatever you're hearing or watching this on, we are also on there as well. Canadian Wealth Secrets. We focus on just that, really trying to unpack some of the things that we consider secrets just because they're less common knowledge. And we really try to expand across all asset classes. We try to talk about all kinds of different strategies, not just insurance and leveraged insurance strategies. We look at things such as the Smith maneuver or cash damming, or should I be taking a salary or a dividend if I'm a business incorporated business owner? And which is better, the RRSP versus the tax-free savings account? And I'm sure you know the answer to that. It depends. And we go through different scenarios to discuss each of those. Anyone who wants to give us a follow on Canadian Wealth Secrets, that would be fantastic. And so appreciate you sharing that there, John.
And I so appreciate you sharing your time with me today. This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.